Looking for your next investment round? Find out how to negotiate to get the most out of venture financing. Do you have the right exit strategy? Should you go for private equity or an IPO? Join our experienced investors, financial, and law experts. Learn how to improve your negotiation skills to get what you want, and learn what goal to keep in mind on your entrepreneurial journey.
And welcome back to Studio One. Welcome back to our next block on This Is Where It Gets Really Serious. We're talking about getting funded. We have a couple speakers coming up. Let's find out who our first speaker is. Let's roll the video. And here he is, Nets Novak from Novak Law. How are you doing?
Great, thank you very much. And yourself?
Fine, thank you very much. I'm quite curious to find out how to negotiate a US-led venture financing. You see what I did there, right? Anyhow, I don't know how that works. You do. The stage is yours. Thanks for joining us. Enjoy.
Thank you very much, dear Podim. Hello and welcome to this talk. Sadly, I'm joining Podim from my office in Ljubljana. I know you're all very comfortable in your living rooms, but I still hope we will all meet in person in Maribor next year. It's a privilege for me to have this opportunity to speak to you about this topic. So let's get started. We're kicking off this Getting Funded block with a talk on getting funded by US investors. I will cover the basic trends of what we have seen is happening in the markets right now. And I'm very excited to share with you, that Jerneja Launcher and Titus Titovski will be joining us afterwards for a chat on the same topic. Jerneja and Titus will share their experience to help you prepare for your upcoming investment rounds. And we will end this block with Peter Globokar's talk on exit strategies. Peter has an amazing track record and his insights will surely be valuable to you. The idea of this topic was triggered by an increase in US VC investments in Europe. This trend was also evident in the CEE region. When we advised on one of these deals, we found that the differences in US and European investment styles and approaches are not insignificant. People often simplify these differences by reducing them to investment amounts, valuations, and liquidation preference calculations, but there is more to it. This also seems to be a relevant topic as more and more founders need to decide how to approach their fundraising. They are unsure whether to seek funding in the US or Europe, or perhaps a combination of both. Perhaps our discussion shows that founders shouldn't care and should approach all investors in the same way. We'll see. And first, I'll do my best to entertain you a bit with some interesting data on this topic. To be honest, US investors in Europe are not exactly a new phenomenon. But we have seen an increasing presence of US investors in Europe over the past few years. In addition to investing in Europe, US VC funds have also established their physical presence here, mostly in London. The best known example is Sequoia, but there are quite a few others. These funds have not only hired local scouts and admin teams, but have even hired some of the best European tech investors to get instant access to their well-established networks in Europe. The amount of money invested by US investors have been growing for several years. From beginning of 2021 to date, more money has been invested in Europe by US investors than in all of 2020 and 2019. US money is in Europe primarily invested in England, followed by Germany, France, to some surprisingly Spain, Switzerland, and the Netherlands in this particular order. In 2018, approximately 7% of venture capital deals in European startups involved at least one US venture capital firm, which is up from 3% in 2013. And in 2019, 2 years ago, 19% of funding rounds of European startups involved at least one US investor. It is worth noting that US investors to Europe typically invest in later stage rounds and rarely in seed rounds. And if you look at the statistics, this is also one of the reasons why average US investment amounts in Europe are that high. And that makes us wonder why US funds increasingly invest in Europe. There are numerous reasons for this, and European venture capital space has evolved and is growing steadily. There are numerous factors influencing this. Several startups and founders from Europe have popularized entrepreneurship across the continent. Since these companies were not concentrated in just one hub in Europe, their stories attracted a new generation of funders from different European countries. Successful exits brought liquidity back to investors and created a new generation of angel investors, as founders and key employees of unicorns ended up with their pockets full of money. And of course, they went to reinvest it in what they know and understand the best, new startups. European startups have also grown in quality. Europe has a long tradition of great engineers, and European companies and startups were known for their technical superiority. But Europeans lacked significantly in brand development and marketing of their startups. This is one area where European founders have improved dramatically in the recent years. A very important reason, perhaps also the most important reason, is the attractive valuation of European startups compared to their US counterparts. There are several reasons for this. The cost of living and talent is generally much higher in the US than in Europe, which is one of the reasons why American startups have no other choice but to raise more money. It seems also that many investors now start to believe that this premium is no longer, or at least less, justified. Let's also not forget about the topic of the last year and a half, COVID-19. Its effect caused some shifts in how business is done and how things operate. We are seeing capital movements from startups not only between the US and Europe, but also within the US, where many have moved out of Bay Area to more affordable and more pleasant places to live, like Miami, where one can find beach, more relaxed lifestyle, and good food. It's also East Coast, so it's easier to schedule con calls with Europe. Investors and startups are also becoming more accustomed to the fact that their primary residence is less important than it used to be. So does that mean that European founders are not going to be coming to the US anymore, since the US investors are coming to Europe more often? I don't think so. I think also that this is a completely wrong way to look at it. And facts essentially also point to a very different picture. In 2020, Y Combinator included a total of 37 startups from Europe, which is 15 more than in 2019. And in winter 2020 alone, Y Combinator had a total of 41 startups from European countries. I'm very proud to mention as well that a Slovenian startup was a part of the last YC batch. So no, European entrepreneurs continue to go to the US to seek both funding and market. However, it seems that not only Americans, but also Europeans do not believe in the America First idea anymore, at least. European startups are delaying their moves to the US. Between 2008 and 2014, 2/3 of European startups moved to the US before their Series A funding rounds. But between 2015 and 2019, that number dropped to 1/3. Startups tend to base their R&D operations in Europe more than before. and they put more emphasis on building their European presence before moving to America. For example, by expanding to London first. A schoolboy example comes from Spotify, which did just that. Before expanding to the US, they expanded to the UK, France, and Spain. And Daniel Ek, who also seems to be very bullish on the European startup ecosystem, publicly mentioned that it would have been detrimental to the company if Spotify had gone to the US earlier, as they weren't ready to tackle the US market yet, and they still had work to do in Europe. A very different observation can also be made regarding the Mediterranean part of Europe, namely Spain and Portugal. Spain has become an attractive startup destination, which was a surprise to many, whilst Portugal is strategically looking for its place under the sun to become a place for startups. They share an interest in South America, probably because compared to Western startups, they understand the language and culture better. They often go to South America before even thinking about the North. It should also be noted that as a B2C company, you may only build a small footprint in the US focused on marketing and sales while keeping all R&D in Europe. For B2B companies, especially software, it's a bit trickier. In this case, there are numerous reasons to be in the US. The enterprise software market in the US is huge and requires more than just the presence of a sales team. Interestingly, favorite place for European startup is not the Bay Area, but New York, San Francisco coming in second, and Boston, known to resemble look and feel of European cities the most, is third. I wonder where Miami will be on the list in a couple of years from now. Many European founders like the idea of raising money from US funds. Some like the prestige, some want the local expertise, some like the working style of US working capital, US venture capital. Many are interested for personal reasons because they wish to pursue their American dreams, whatever that means today. But there are many rational arguments for a US-focused approach as well. Typically, investment sums in valuations are higher in the US, which attracts European founders. Larger investment sums combined with lower costs in Europe allow for a double win for startups. The US is a very large market, and it is often difficult to enter successfully without strong local support. This support can be secured through American investors, so startups often want American funding, also to help them establishing their presence in the US distribution channels and other smart money benefits that come with it. In particular, B2B companies want American investors to help them attract customers as well. But there are other reasons as well. Sometimes things just click between the founders and the investors, and they really like each other. There are also many investors in the US who specialize in certain industries or niche products. Funnily enough, the arguments for why not to join US investors are rather identical to the arguments for it, except they are a mirror image of the former. Some founders simply prefer European lifestyle and cannot imagine their lives without good coffee and buying locally produced vegetables on Sunday market. Debates on contractual terms differences is certainly a bit stereotypical. If you look at them, you think that the differences are often not that huge, but sometimes still rather material. I personally think that European and American investment styles are becoming more and more similar over time. But nonetheless, maybe a quick review of some of the differences will help you avoid unnecessary surprises. I think the first noticeable difference is that American investors sometimes move insanely fast. In Europe, it is usually perfectly fine to respond to emails by the end of the day or beginning of the next day. And Americans often expect responses within minutes. Investing is a lot about first impression and trust, and therefore your slow response could be understood by Americans that you are not focused, really interested, or just not well organized. It also seems that in early conversations and rounds, Americans don't care so much about the technical details and profitability, but rather focus on the product, the market, the problem to be solved, and the growth potential. It makes sense that you adjust to this and switch your focus to these topics. We have often seen that American investors are pretty picky about the list of key employees and vesting rules. In Europe, vesting is often neglected, especially when it comes to the position of the founders. American investors therefore often catch European startups off guard when the founders are not able to explain the list of key employees and vesting, or rather the lack of them. Even though Europeans still prefer to invest directly into equity of startups, they're becoming increasingly relaxed to use convertible loans, which simplifies and speeds up the process. But Americans, by definition, use safes and convertible notes, especially in early rounds. Here, we can once again see how performers optimized American approaches. In any case, startups will not feel that much difference and are now familiar with both structures already. One could also see differences in liquidation preferences. Typically, they are more founder-friendly in the US, where double dips and more than one-time liquidation preferences are rarely seen. This question is not uniform across Europe. You can easily run into European investors who will try to negotiate a more investor-friendly liquidation preferences, such as double dip or 2x preference. Founders are educated enough already to push back on these ideas. A similar tendency can be seen with anti-dilution clauses. Americans typically use a weighted average or similar approach, which seems fairer, kind of. And Europeans like to try to negotiate fixed valuation, which triggers anti-dilution protection clauses. It is simplified, but can be very unfair if such fixed valuation is set highly above the valuation of the investor who enjoys the anti-dilution privilege. European investors are also like to retain substantial governance rights that allows them to interfere with the company, even though, at least in our experience, we rarely, practically never see them use it. US investors are more relaxed and move away from rights to interfere drastically, as they probably believe that once they would have a need for that, money is lost probably already. This ultimately leads to American term sheets often being short and sexy, while European ones tend to be a bit longer and clunkier. In our experience, that's not necessarily always a bad thing. Many first-time founders appreciate term sheets, which are drafted in a bit more instructive way and therefore longer, which helps them get them understand fully. I will only take a brief comment on exits, as Peter will have more to say on this topic. But recent trends have shown a strong PE, private equity exit movement and fewer IPOs, which I think will be the focus of Peter's presentation. We have also seen a recent SPAC trend in America, while there have only been a handful of SPAC deals in Europe. It seems that if one chooses to do an IPO, the US is still likely not necessarily the better place. Private equity exits are currently less influenced by investor location. What is a noticeable difference in the exit expectation of investors, founders, and key employees comparing Europe and America is that Americans seem to be more confident and aim for higher exit valuations, or rather say no to the present offers. Titus will be able to share more insight on this later on, but it seems that the valuation milestone where European founders like to say yes is significantly lower than their American counterparts. And this could lead to disagreements and tensions between American and European founders, investors and founders in the same company. And this brings us to the fundamental question of this whole block. Is there really a paradigm shift taking place here? If you ask me personally, I don't think so. We are just seeing a confirmation of a longer lasting trend. COVID-19 has accelerated some of that, namely the irrelevance of current physical location and the ability to do most things remotely. VC industry is pretty relationship-based, and this was a pretty groundbreaking move for them. But in any case, the general processes of globalization continue to work. US investors do not approach Europe just for the sake of it, but they see good investment opportunities here, and that's why they invest. Similarly, it's also in the founders arena. Founders shop for investors and choose the one they like better. And that is a very healthy approach. In the end, your business case, your product, your energy, your dedication, and your skills are the most important things, and probably not the origin of your investor. This was a brief intro into the trends that we've seen in the markets lately, and hopefully we will now upgrade it with further insights and details on what are the differences and how to successfully negotiate deals with European or US investors.
Thank you very much. And I believe that's my magic word to announce the upcoming panel. Let's find out what the panel is all about. Let's roll the video.
It is time to rethink and to realign, learn and get inspired. Prepare your questions and enjoy this insightful Podim DX panel.
And now the panel is about to start. Only two more things to do. Number one, announce the name of the panel, and that's negotiating a US-led venture financing, a chat for investors and companies. And number two, to hand over control back to Nate, whom you've met before, who's going to introduce you to his panelists. Stage is yours again.
Thanks. Great to be back again. And not just to be back, but to be accompanied by two amazing, actually, I can proudly say friends of mine already. Irnea and Titus are here to join me. Welcome. And allow me firstly to introduce them. On a personal note, Irnea is one of the most fascinating people I've met in the last 5 years or so. She laid her footsteps in the VC world as a founding investment manager at General Motors Ventures and worked a lot on deals in America and Europe. Today, she's the founder of Good Tech Ventures and is professionally addicted to helping startups and their founders. She is nice and understanding, but turns into a shark in a blink of an eye, so do not joke. I always have fun talking to her, and I have no doubts you'll enjoy talking to her today as well. And moving on to Titus, we have met not that long ago. Titus is a lawyer and a founding partner of Zitowski Law, and he's devoted to helping European startups get funded by American investors and spread their wings in American markets. He's also an angel investor, so do not bore him only with your legal problems. He's a great lawyer and a very nice guy, and this is not often that you hear something like this to be said by one lawyer about another one. Welcome both. I'm really happy to have you here. I think I have spoken a lot already in the last 20 or so minutes. And there is another stakeholder in this chat that I would like to mention, and this is hello again to all of you, the participants. The three of us are very excited to hear your comments and questions, and we challenge you to ask us something the three of us don't know an answer to. And each of you who will refuse to participate in this chat will be punished in the end. Okay, let's dig into it. Irnea and Titus, are you ready?
Hey, hello. How are you?
Hi, everyone. Ready to start?
Great. So straight to the point. How do the EU and US investors differ in thinking about a potential investment the first time they see a pitch deck? Irnea, ladies first, can I challenge you on this one?
Yeah, absolutely. I would think if not to go too much into details, my experience is that US investors would look for how big is this opportunity? How edgy is this idea, and how strong is the team, versus probably oversimplifying, but I think things that are more tangible is something that, for example, a continental European investor would look at, the strength of technology, for example, or the patents, or the existing revenues.
Do you think this you think this mostly comes from the fact that there is a longer tradition and higher pressure for very growth-intensive companies in America, or just a different heritage or culture?
It's a mix of both, and then in addition to that, I think there's being comfortable with higher risks, so more of a high risk, high return mentality, and also pressure on the venture capital fund side, right? I think the pressure to get to really high exits, meaning that they need to place bets on opportunities that could potentially bring huge exits.
Titus, you've been on numerous investment rounds led by US investors. How did you feel? How did they approach these rounds compared to their European counterparts? And how did that affect the behavior of the founders raising these rounds?
Okay, so I think you have to realize that venture capital is a separate industry. So it's very standardized, it's very commoditized. Therefore, there is a high level of repeat and speed. So transactions with US VCs are definitely a lot faster than with European VCs. I think, venture fund or venture GP does maybe 1 or 2 deals a month. So there is a lot more activity, and GPs, venture funds are on board. So it's very quick, intense, and I think founders from Europe are mostly shocked how fast decisions are made, and just the general expectations of executing really quickly also on term sheets and negotiations.
Renea mentioned that that American investors might be more comfortable with higher risks. Do you feel that on these transactions? Do you feel like that American investors are more likely to make jokes around things they do, or is this just the way they communicate their thoughts?
Look, I think venture capital is about giving money to folks to make mistakes, and the business model is based on losing 90% of your money. So let's say it's a fund that is 100 million, you lose 90 for a small chance of 10xing 100 million. So that's the probability, and yes, it's high risk, and you have to be really comfortable with losing all of your money for that small probability of 10xing your investment. And I think Americans are more accustomed to risk than Europeans, but as you mentioned in your introduction, that is changing, and more entrepreneurs as a class are showing up in Europe in general. But I think in terms of risk taking, funding frontier technologies, founders with crazy ideas, founders who are not that friendly, I think it's more in the Bay Area and in the US. It's no accident that Tesla was created in the US and not in Stuttgart or Munich.
Oh, that's a very interesting point. But do you think that the differences, and this is a question for both, do you think that the differences are so material that European founders, when they prepare to pitch, do you think that they should approach American investors differently from European ones? And in what elements should they adjust to who is on the other side of the table?
I think if you're talking to a 5-year-old and if you're talking to your mother, you speak in different ways. So I think there is a different way of addressing different people and focusing on different things. It doesn't mean that you have to window dress and manipulate, but I think US investors are focused on growth. They're focused on founder market fit, while many European investors, and this is a generalization, focus on profitability and early traction.
I'll go with a similar answer. I won't go with the mom versus a 5-year-old, but I think if you speak in a different language, like if you speak German versus English, you probably incorporate some cultural aspects as well. So maybe if you speak English in Europe and then you speak English in the US, you forget how different the culture is, even the general culture, the general business culture, but then there are differences also within the venture industry. So I think you need to know what you're doing and why and what you need from the investor, and that shouldn't really change, but you definitely adapt your language that comes with many nuances. So I guess the answer is kind of yes and no. But definitely know your audience, right? I think you need to know that their expectations will be different.
Right. I can give you an example. I'm based in the Bay Area and now in Miami, and I had one European VC from a very old country come to the Bay Area where informality is key. Everyone wears business casual with a tendency to more casual, and he showed up on Sand Hill Road in a perfectly tailored bespoke suit and a tie and amazing shoes, and he looked straight from a catalog of fine clothes in the UK, but he totally didn't fit into the Bay Area milieu.
That's an interesting point, but Titus, I think you more made Paul from Sharkbike and myself also think about your Tesla comment. Paul is wondering if a company like Tesla would have had funding chances in Europe at their early stage and onwards. And I would like to add to this that if I'm not mistaken, don't hold my word for this, but I think Daimler was essentially one of not really early, but one of really big investors into Tesla. How do you see this this story developing? And also, do you think that there is an increasing but still healthy rivalry between European and American both entrepreneurs and VC investors?
So I can't answer for the Daimler question, but I don't. But I know for a fact that Elon Musk did appear in Europe and wanted to get funded by the venture arms of the big German car companies, and the answer was no. So that's a fact. And I think the second question. Is there a rivalry between US and European VCs? Definitely there is. And, rivalry and competition is good for founders. And basically Europe so far has been a VC market, and VCs haven't been competing for the best founders. And that is starting to happen with more VCs coming to Europe and doing directly originating deals in the US, in Europe. And I think that's a key to remember, that origination is starting to happen in Europe by US VCs. And that's a good thing for founders.
Nita, you've been on both sides of the table with American and European counterparts. Did you experience this a little bit of rivalry, or do you think that it's just like a healthy competition?
Just a quick note on Tesla, because I think it's a good example. So during their early times, they made very bold decisions on technology side, and for especially German investors, especially German strategic investors, I don't think they could ever be comfortable investing in technology that was not mature at all. So I could see how Silicon Valley could get behind that, but not a German strategic investor. On the competition side, first, on if we talk about startups, I definitely think it's healthy. I think it helps investors screen opportunities based on how skillful the founders are in terms of knowing their competition outside of their country, outside of their region, outside of their continent. It's a really good sign when they say, well, we're not direct competitors, but they really know the global competition. That's always a good sign. The sad part of that, especially trying to invest more in Europe, is if you see a certain startup win just because they raised so much more funding. And let's say, on all the other fronts, maybe the European startup is so much more advanced, but oftentimes if there's 10 times, 20 times more funding, it's just hard to compete. So that's sometimes the pain point of a European startup.
And if I can add to this, there are some areas where U.S. investors are, looking really intensively, and that's definitely London, and that's definitely Berlin. But there's also a different trend, and no one is talking about it. There's European VCs showing up in the Bay Area and establishing their own shops there. Creandum is one of them. Karl Frotjofsen is there permanently. In our backyard, we have Credo Ventures, who had their own shop in Menlo Park with Andrei Kishka there. So it's a two-way street. And it's only for the brave to go on that two-way street. It's not only Americans coming to rattle their saber in Maribor, but it's also Europeans rattling their saber in Menlo Park in Palo Alto.
When do you guys think that it might not be the best idea for a European startup to try to raise money from the USA and should rather just focus on finding European investors? Do you think that there are some characteristics of European startups that make them less suitable to run for US capital?
Well, there's one scenario where I think that might not be the best use of founders' time. For example, if there are no plans to focus on the US market, potentially ever, or just, there's no plan yet how they would benefit from that market. So in that case, it might be better if if your market is Latin America, then why would you go to the north? So that's an easy one, but there might be others.
Okay, so what I would add is the VC business is very local and it's very personal. And this is both for pre-COVID and post-COVID world. In the pre-COVID world, if you didn't have any customers in the Bay Area, it didn't make any sense for you to come to the US and look for funding. And I think Bay Area VCs can look through all of the startup tours that show up or showed up back then. And there's no reason for them to invest if you're not local. So that's number one. Number two, that has slightly changed post-COVID and people are more open. But again, it's very personal, it's very local, and a good investor wants to get in front of the founder, wants to help, and it's very hard to help someone who is in a different time zone, or you have to travel 12 hours to get to Berlin or maybe 15 hours from Berlin to the Bay Area. So I would discourage founders from traveling unless you're ready to go after the US market and you're committed, because there's a lot of people who come to the Bay Area shop around on Sand Hill Road or go to South Park, and then they're seriously disappointed that no one is interested. It is a different league, and as everyone mentioned here, there are different expectations.
Firstly, I need to thank Martin for sharing an info in chat that Daimler bought 10% of Tesla in 2009, a year after Elon became CEO, and sold it in 2014. Martin is commenting that their timing was right when it comes to entering and not ideal when it comes to exiting. So it looks like they didn't feel that comfortable with the unproven technology, like Irnea mentioned already before, and they preferred to run. But moving on a little bit, do you think, have you seen some typical mistakes, or at least not best moves by European founders when they negotiate with the US investor? Are we able to kind of draw an advice from events like this to recommend to them what they should try to avoid doing when they discuss deals?
I can think of a couple of things. The first one might be more on just presentation, communication. It sounds very stereotypical, but I think confidence is still appreciated a lot in the States, right? So I think I would pitch differently to a Menlo Park VC compared to a German engineer, right? I think I would definitely have a different stance. And then the other one is obviously you want more than one investor, but as soon as you have more than one investor on the board, you can be in trouble. And then if you have very different investors on the board, there will be a little bit more work. I think it's good to expect that. I think it pays. It's very beneficial to think about who are you bringing in as investors, and are they compatible, or are you going to have headaches years down the line? I think it makes sense to think about those things.
So the question is, what do you need? What do you need for pitching a Silicon Valley investor? Was that correct?
Kind of, or typical errors, what not to do when you pitch.
Okay, so I think, number one, be sexy, be personal. If you're going to be bringing in an investor, you want to feel comfortable and you want to show your personality and who you are, and not be, generic and hide your, cards. So I think, being personable. I would also focus on positive things. Eastern Europeans tend to be negative, so focus on positive things. Show what you will bring to the table, what you will give, and not focus only on taking or getting a term sheet or getting the investor on board, but also give. The last thing, even if someone tells you no, it's super important to follow up and be in touch. And that's the power of the Silicon Valley network of constant follow-ups. So if someone tells you no, ask them why, get the feedback, stay in touch, follow up. And there's so many founders that come to the Bay Area, meet with me or meet with investors, and they never show up or follow up again. And that's sort of disappointing, because we want to stay in touch with ambitious founders.
Yeah, there's one more thing. Probably, I don't know if it's the biggest mistake, but the one I notice most often with European founders. And Nate, you spoke about the expectation of replying to emails almost real time. But I think even more importantly, maybe you get a no, but please stay in touch. And then unprompted, you might get an email a month later, 2 months later, from that VC saying, by the way, what were you saying if if we give you a little bit more funding, what could you do with your product, or is that right? And you would get a random question like that. And I think in those instances is really important. There's obviously something going on. Maybe it's just maybe the VC is just trying to understand the space, but I think it's very important to get back to them very quickly. Like, don't spend, and I've seen founders taking 2 weeks or 3 weeks to polishing their response and preparing a large deck to back that up. But I think in those instances, just call them or reply back as quickly as you can, and then see what's going on.
That's a very interesting point. I've heard a couple of months ago a US investor say to a European founder, this is the amount we want to invest in your company. If you won't come back to me ASAP with a very good explanation how you're going to effectively spend this money, I'm not investing anything. So it looks like there is a stronger push from Americans to quickly deploy money efficiently. And that maybe there is a tendency in Europe to kind of be more careful with spending or using the money.
I'm not sure. I mean, I definitely want to make a distinction. I don't like VCs putting founders on the spot in terms of, you need to accept this offer or we're no longer interested. I don't think that's a good practice. And I think most funds no longer do that. But yeah, I don't know. I think it's just general pace of doing business. I'm not sure if it's being more risk averse. I'm not sure if it's more detailed due diligence potentially, but I'm not convinced.
Okay, maybe a question for. Oh my God, I'm double. Maybe a question for each of you, and for Titus, if he's still with us. I tried a little bit to shed some light on differences in typical contractual terms differences between US style investing and EU. Maybe if you can add some on that. And to Yernea afterwards, I think you spent quite some time looking into the details of board structures, and that there are quite some differences between how Americans approach this and how Europeans. So maybe these are two interesting questions to kind of elaborate on what can the founders expect to be different. Maybe Titus, if you go first.
Sorry, I had some static. What was the question? Expectations of founders?
No, I tried to earlier to kind of show some typical differences between standard investment terms in term sheets between US and Europe. So maybe if you, because you see a lot of this also, if you can maybe add something to that, or maybe correct me if I was wrong in some of those. And well, Nate, I think you heard me earlier, right? Yeah. Okay.
Yeah, so term sheets in the US are definitely shorter, and they're shorter not because lawyers are expensive, but they're shorter because there's some customary things that are standard. The deals are definitely focused on maximizing wealth and not control. Many times VCs don't take board seats, they don't exercise their veto rights, and they let the company grow. So I think that's like the main area of friction. Most US deals are focused on wealth maximization, while most European deals are control maximization, from my experience. And that's particularly true, in my opinion, for deals that originate out of Eastern Europe. They're very control heavy, and there's very few local VCs that focus on wealth maximization.
Yeah, happy to share my thoughts on boards. I'm definitely not an expert. I know enough not to get into in trouble now, sitting more on European boards versus the Anglo-Saxon style boards previously. So I would say mostly my experience are from the US and Germany, and just day-to-day difference in what how those boards were different for the founders is probably that in the US, we had a very common practice that we would have regular sessions, and then we would also have executive sessions where we would ask the founders to step out, and we would talk just external board members about what we could do to support the founders better, or if there were any challenges that we first wanted to align about and how to approach them. And when we tried to implement that in Germany, there was a lot of pushback and also some fear. What are they going to do to the what are they going to do to the founders? But my experience is that can be quite helpful in terms of really supporting the founders, aligning and not using their time and energy in one single session. But I think it was sometimes very difficult to accept that for European founders initially. I guess what I'm saying, it's for the benefit of the company and of the founders, even though it might feel strange, your investors and your board members asking you to step out of the room.
I mean, this sounds like you could draw some parallels to the differences between a mature, not venture capital, but mature corporate world in Europe and in America, because there is how we could say is that there is more dynamics in how American boards function, and there are, let's say, more rules or more structure to the way European ones. Also, the fact that Europe knows a two-tier system, separation of the management and supervisory board, and in America, to my knowledge, there is only a one-tier system with execs and non-execs in the same body, essentially. So this is maybe where both worlds do join a little bit.
I think the board question is very important. I don't think many European VCs understand the consequences of flipping it to Delaware and having a U.S. board. A lot of European VCs on boards believe they're acting in the best interest of their fund, and ergo, that is the best interest of the company. In the US, we have fiduciary duties, and even if a VC is elected by a certain class of investors, he still has to act in the best interest of the company and be loyal to the company. So that's, I think, a big difference that I've noticed and surprise from European VCs.
There is a common understanding among European founders, or expectation, that getting funded by a US VC fund is also going to help them establish their operations in the US, get better connections to the market, sales channels, that there's going to be perks attached to this capital, which is going to help them business-wise also, not just money-wise. Do you think that still holds the truth? And is there a huge difference between how much smart certain capital from US is and some might not be that much?
I think getting capital from top tier VCs has exceptional benefits. It's for all of those people who've never hired anybody for their organization. Getting a Sequoia or getting a Kleiner or getting Atomico, a cell index in the cap table helps with hiring and attracting people. So I think, yes, it helps. And the perks are, really big, because For example, in the hiring department, it helps.
So definitely hiring, and also the top tier VCs will have pretty impressive networks. So the introductions that they can help with should be very helpful. And if not that, if nothing else, you'll probably get very specific KPIs. They will want to see how good are you at entering the US market, or expanding your presence in the US market.
And just to follow up on what you said, many top VCs are former entrepreneurs who were able to grow an idea into a billion-dollar company. So they have actual, experience in the same pain points you're going through, and at the same time have also connections to your potential customers for your software tool, and also have connections to companies that are looking to acquire teams. If you're looking to do an acqui-hire. So yes, good VCs bring a lot more than a big check. They also bring network.
Titus, when we talk about flipping or moving or going to USA, what is in your experience a most typical structure? Does it really mean relocating the whole team or most of the management team? Does it include moving the headquarters in corporation sense to the US, or is this like an additional upgrade? And a very hot topic, is there a tax leakage when you do that on the founders?
Good question. So, if you're looking to get US investors, most of them only invest in US based companies. So the operations have to be in Delaware. It also means that you need to have the CEO move to the US and be close to the new board. It means that R&D stays in Bulgaria, Hungary, or Poland, or Romania, and you start building a new organization or new operations in the US, and you're growing a global company, and that chapter of being in Europe is can continue, or a new chapter unfolds in the US. From a US tax perspective, there's the flip is usually tax neutral, and from a local European perspective, the answer is it depends, but it can be structured in a mostly it could be structured in a tax efficient way.
But now we have US funds having their offices in Europe. Does that mean they will still invest in Delaware entities, or is that notion changing as well?
I think they will keep requiring the flip to the US.
Okay. Irina, anything else to add on this? Because otherwise I have a very exciting question for you, which I think you're gonna like a lot more.
Go ahead.
We've seen a trend in Europe that European venture capital seems to be focused or interested on many other things which Americans are not. Meaning, if America had the notion of software is eating the world, Europeans seem to be interested in healthcare, food tech, green technologies. You have your own interest in mission-driven profits, mission-driven for-profit startups. And do you see a very different dynamics coming from the fact that European founders are interested in other industries and there is less focus on software only?
Not personally, no. So I guess at least the investors I talk to, the deals, the opportunities that I see are equally rich and diverse regardless of geography. I'm especially interested in single bottom line impact, and I think that's gaining momentum, and regardless of location, really.
Okay, makes sense. Then going forward, expectations of stakeholders when they discuss U.S. funding. So we've seen that U.S. investors care a lot about the funder structure, the key employees list, the vesting, and expectations on how the company is going to continue to grow and what their strategy is going to be. Has any of you seen that maybe key employees were not fond of ideas over strategy over European companies in that sense? Or is this typically well accepted? And does it cause any friction within the the main team within a startup?
I was just recently eyewitness and also participant in a deal in Serbia, where one of the early employees claimed he was a founder of the company, and it caused a huge disagreement between the new investors, the seed investors from Serbia, and the founding team, and it caused huge disruptions. And there's definitely different expectations. There's also different expectations in terms of when to sell. A lot of European founders, especially from Central and Eastern Europe, when they hear the 100 million sale price, they get excited, while most US VCs don't care about that number because that doesn't even return their capital.
Yernea, any more thoughts on this?
No, I agree. I agree with what you guys said. There's another thing that initially I thought, well, there's always conflict, or often conflict, among founders when things are not going well. But actually, unfortunately, oftentimes there's conflict among founders when things are going very well. And there's just, I think that doesn't have to do with the ecosystem or the location. I think that's probably universal.
Do you think that it makes sense for startup to try to pursue getting the best of both worlds, meaning that they seek investors where one lead investor is going to be from one continent and a co-investor from another? Do you see benefits in this? Or is the notion that these differences are fading away, and that it is more important that the particular investor is a good fit for your startup and not essentially where it comes from?
I noticed a different trend, actually, Nate. A lot of VCs from the Bay Area are looking for local partners. So a local VC for Bulgaria, a local VC for the Czech Republic or Poland. They don't have experience in those regions. They can't help in Poland or the Czech Republic. So they're actually looking for local VCs to help them in growing the company.
Yeah, it has to do with the stage of the startup as well. I think it makes a lot of sense to stay local and then regional, and then maybe with time, closer to IPO. When you're already heavily international, right? It would make sense to go with investors where your markets are, but I think not too early.
And now, slowly making an intro for Peter, let's say one or two words about European startups successfully expanding to the USA as well, and ending up with doing a successful IPO. We've recently seen pretty big movement here, and we've recently seen some big names from Europe be presented on billboards of New York Stock Exchange. Do you think it's still a Europeans' entrepreneurs' dream to drive their companies to American IPO. Do you think this is still something worth pursuing?
I think it's worth pursuing. An exit is a lot of hard work. Getting to an exit is hard. It takes a lot of blood, sweat, and tears to get that multiple. I had the privilege of doing the Series A and Series B for UiPath for the initial investors, and it took them a lot, and it took a lot from Daniel to grow from just being a software engineer with a heavy Romanian accent to become a CEO of a global company, still with a heavy Romanian accent.
Neta, do you think European startups are enough focused on thinking about exit from early enough? Or do you think that?
That I was gonna say, I don't mind if their dream is not, exiting by being listed on a U.S. stock exchange, but sometimes personally I am discouraged if I don't see them being ambitious enough, and that includes not being ambitious about their exits.
And if I can just follow up on that, amazing founders should be focused on product and being in front of their customers and listening to customers and building products that people want. And by building things people want is also connected to monetizing that. And if you're not focused on monetizing the product, then there's a problem. And you should definitely think about are you building a hobby, a lifestyle business, or you're looking to get rich and with the help of your customers.
And now my biggest concern of this chat is since you have a lot to share, I'm afraid that there was something you wanted to share with founders, and I haven't asked you an appropriate question to say that. What would be, as kind of conclusion to this debate, an advice or recommendation to European founders who are pursuing a capital round from the US?
Yeah, sure. Happy to go first. I think I've mentioned this before. Maybe the culture is different. Maybe they're speaking a different language, but it's still you, the founder, who knows what they're doing, why they're doing it, and what they need. And I think it's very basic, but as long as you can explain that in very simple terms, you should be okay.
Okay, my 3 points: come prepared. That means number 2, do your homework about VCs. And number 3, show your growth. Show how you're amazing. Show how you're going to build a $1 billion company out of Maribor, Ljubljana, Bucharest, or Sofia. Be ambitious. Be super ambitious.
And on this note, I wish to thank you both very much for sharing all these thoughts. I hope we have helped everyone listening to this to kind of get their hands around how to approach and talk to US investors. I enjoy this a lot. I've heard many new things, and hopefully I get a chance to use them in practice rather sooner or later. I hope the two of you also enjoy this, and that I didn't limit you too much with my questions. I think we're now going back to Daniel, who is going to tell us about what awaits us listening to Peter.
That's right. Thank you very much, Nate, and thank you very much to your panel. It was really very fascinating to listen in. Thank you so much. Actually, I'm not going to tell you but the video is. So let's roll the video as ever. And the next talk is going to be on the right exit strategy, IPO versus private equity. Now, that's a very fitting end to the day. Let's find out what this whole thing is all about. Time to say hi to Peter Globokar of Stifel. Hello, Peter. How are you?
Daniel, I hope you can all hear me okay.
Loud and clear.
Good afternoon. You've been doing, all of you, 2 days of Zoom, so your eyes and ears must be buzzing with all of the input you've gotten. So listen, it's a pleasure to be with all of you this afternoon. I know this is one of the last sessions you'll be listening to, so I'll try and make it interesting. I put a few slides together for you, which we'll cover. Obviously, first of all, thanks a lot for having me here on the Podim conference. I hope it was a good, successful event for everyone so far, and let's continue to do this. Now, I hope you can see my screen and my presentation. Just there it is. I think that's perfect. So first of all, I've extended the title. I think it was all about IPO versus private equity, but in reality, I think it's important to add M&A. And rather than telling you what it takes to do a successful IPO or a successful private equity round, which we can talk about a bit later, I really wanted to go into the nuts and bolts of where's the exit, where do you find it, what's the right exit, how to think about the various options, and really focus on this in your minds, because you're all good at telling your equity story. You're all good at building relationships, which are really two of the key ingredients of getting to think about your exit. But it's all of the mechanics of it, etc., that I wanted to cover a bit with you. So before we dive into this, very briefly, for those who don't know me, I'm a technology investment banker, 25 years of deal making. I've probably closed about 100 exits in my life. In those 25 years, worked for a number of companies, and actually also my own business, which I sold to Stifel 18 months ago. So I've been an entrepreneur like many of you for about 15 years until we were approached by Stifel, and me and my partners decided to sell our company to them. So I've been through an exit myself, in real, not just telling people about exits, but actually doing them. I'm also an investor in startups and in private equity, or rather venture capital funds. So I have a good understanding of the dynamics that also the earlier stage businesses go through in their growth and in their quest for growth. And then finally, I'm Slovenian. I'm French, I'm a global citizen, but I grew up in Germany, in France, in the UK. Slovenian background. I'm trying to be in Slovenia often, and so there's obviously a personal touch to the whole Podim conference, which I quite like, and really glad to be with you here today. So let's look at what we're going to cover today. I want to give you a bit of an update on the market because, believe it or not, we are in a bubble, and I think it's worth taking a pause and understanding what that means, and looking around us a bit, what it means in terms of exits and in terms of what we see around. We'll talk about what actually is an exit, because I think we put a lot of thoughts into what an exit is, and we need to define them a bit clearer. We'll talk about IPOs and why I think IPOs are relevant sometimes and why I think they're not. We'll talk about private equity, and in particular the growth side of private equity, and what it means for you as a company and as an entrepreneur. We'll talk about M&A, and the fact that actually M&A is probably the most pervasive way to exit a business, because it just happens, and sometimes it really happens without you wanting to happen as well. And then we'll talk a bit about the process. So hopefully that will give you some insights into the world of exits, and then hopefully we'll have the time, of course, for you to ask questions, which I want to make sure you have the time to do. So let's talk a bit about where we are today, right? This chart shows you the amount of money that sits on balance sheets of central banks. Essentially, it tells you how much money is in circulation in the real economy. It tells you that there's a huge amount of money that has been printed over the last few years. It was already the case after the 2008 crisis, but it, of course, massively became the case again with COVID. And so what that means is that there is just a huge amount of liquidity in the market, that this liquidity today effectively drives a huge amount of valuation upside and uptick. And if you look at this slide that takes you through 40 years of NASDAQ and the index in the US that basically is the reference index for technology stocks, what you notice is that actually, the bubble that everybody, or that some of us remember at least from 20 years ago in 2000, which was the internet bubble, was actually a small blip in comparison to where we are today in terms of valuation levels, and in particular in terms of the acceleration of valuations in the market. So it means what? It means there's a lot of money in the market. It means that there is a lot of exuberant focus on the growth part of the segment, and everybody wants to have a play. Everybody wants to have a ticket in the ride of growth technology investing, right? That means that this slide here on the NASDAQ index tells you that public listed equities, so share prices of tech companies, are at an all-time high, but also continuing to grow crazily. And of course, every day there is talk of this being the end of the music, etc. But for the moment, nobody's seen it. And that graph basically tells you that story. It also tells you that the spillover of public valuations into the private market is there too. So you know that private companies are being sold at higher multiples because public companies can afford that, and there is inflation on the M&A side. You know that because there is an inflation on public equities and on M&A, there is also an inflation in the valuations that entrepreneurs and investors are looking to get when they sell their companies and when they get new investments, right? So we're basically in an inflated valuation world right now. And the question is, what does that mean, right? The bubble is essentially a situation where you have money that is looking for deals rather than deals looking for money, which means that if today you have a sound, solid business with solid growth prospects, you should be in a better position than ever to raise the funds that you need. But you also should be in a better position than in over many, many other years to sell your company or to list it or to find acquirers either on the private equity or on the strategic side, right? Today, the best symbol, I think, of the money that is available to technology stocks are SPACs. And some of you have heard about SPACs. This is short for special purpose acquisition companies. It's essentially the ability that people have today in the US to raise empty shell or cash for empty shell companies. So you set up a company, you say, I want to raise 300, 400 million for this company. I'll put it on a bank account at the company. And eventually I will find a target, acquire this target with this money, and the company will become listed, right? So it's not only a shorter way to do IPOs, and some European companies are starting to see this. You've seen some examples of this, which I'll come back into. But it's also a way for investors to effectively invest their surplus of money into projects they don't even know which ones they'll be yet, right? So the bubble is also when everybody becomes a venture capitalist, when sports people, when pop stars are basically backing the idea of saying, oh, I will endorse a SPAC, I'll market the SPAC with you, let's go and find the deals together, and we'll invest in sports and entertainment and travel and etc. in new ventures. And you have to ask yourself whether sports people and entertainment people and rock stars and film stars and whatnot are actually really suited to deciding what is a good investment and what is a bad investment. What does an investment need to be successful or not to be successful, right? And this idea that everybody should become or wants to become a venture capitalist and therefore can become a venture capitalist and should become a venture capitalist, for me, is a very clear symbol that we're in a bubble. And finally, you see in these SPACs a lot of businesses that have that are at pre-revenue level, that are valued at billions of dollars today on the stock market. In other words, people hold shares in businesses. They've invested their savings into shares of companies that haven't seen an inch of revenue yet, and that sometimes are working on a prototype that will come out in 12 or 24 months from now. Now, there are not even a lot of venture capitalists around that would invest into businesses like this, right? So all of this taken together tells you that we are absolutely in a bubble. And what that means is that today the prices are high, and that bubble at some point will end and the prices will go back and be low. You might catch the window of the bubble, which will make you a hero, and it makes a lot of people heroes in this environment, but you might not. And so you need to understand what happens beyond this period we're in, which is very exuberant and very exciting. And you need to look over the horizon and say, okay, fine, it might not be like this every day. Therefore, I need to understand what exits means in the larger context, right? So this is my little intro to tell you that we live in a very, I would say, exceptional period of time, which will inevitably will look pretty different at some point, right? And God knows what this will be, and I'm not a crystal ball gazer, but certainly have seen the first bubble to know that when it ends and when the music stops to play, it means quite a lot for smaller companies in particular, in terms of their ability to raise funds, etc. Let's talk a bit about what's an exit. An exit, first of all, is the real question is it the end of the chapter you're looking to achieve with an exit, or is it the end of the story together? And here you have, an itinerary of a sailboat going around the world, starting in Portugal, ending up again in Europe, with lots of stops along the way. And think of a fundraising, think of a private equity recap, think of an IPO actually as many of these stops along the way. And the real exit, if you think about it, is actually not the IPO, because you're still the CEO, you're still in place, you still have shares in the business, you still are linked to the business. The end of the story as such is really when your company gets acquired, you don't own a share anymore, you're not the boss anymore as an entrepreneur. That's the end of the story. And this also means that not everybody exits in an exit, right? You have an entrepreneur exit and you have an investor exit. And as this quote here says, which I like a lot, it says, the world is divided between those who stay and those who leave. And I explain this every time I work with people on an exit. When you do an IPO, yes, some of your investors, most of your investors will sell their stock at IPO or shortly thereafter, and they will say, thank you very much, we've done a great job, we'll stay friends. But the one who stays in the business is the entrepreneur, right? The one who stays in it with its assets, with its investments, with his life achievements is the entrepreneur. So an exit is not an exit for everyone. And I think it's important to remember that when we talk about exits. An exit is a huge effort. And I know we heard some of that in the previous chat with my friends that were telling you a bit about US and investment rounds, etc. An exit is essentially a huge effort with an uncertain outcome. You can be preparing for an IPO for 12 months, but if your numbers don't stack up when you decided to do your IPO, it will not happen. And so I always say, look, running into an exit process is a bit like starting to jump off the roof without knowing whether you'll fall into the swimming pool or actually on the concrete next to the swimming pool, which you don't want to do because it hurts. And so you need to really think very hard about getting into an exit in a planned way. And you need to think about it very hard to make sure that you're ready when the moment is to exit. And you need to make sure that you have a good understanding what you're setting yourself up against in order to be successful and not destroy what you've created until that particular moment. It's also something that happens at a certain point in time. So you as an entrepreneur should really try to control that moment. And you should try and have a vision again about your exit. So don't wait until you have 10 million of revenue and say, okay, now I need to start to think about my exit. The exit is actually there when you start your business. You need to know what it is you want to achieve. Is your goal to IPO the business? Is your goal to be bought by private equity? Is your goal to build a business fast, sell it to a strategic, and move on to other projects? This is something that you should clarify in your mind as well. And it might be all three, but you need to think about this quite carefully. So let's talk about IPOs. Why and why not? And here you have UiPath as a picture. I think it's a fantastic story. It just shows you what a successful IPO for the right reason means. And it's a company that many of us didn't even know a few years ago, that ticked the box every way along the way, that did a fantastic job to get to where it is. And it absolutely was the right thing to do for them. And they've done a fantastic job, right? But what is an IPO? From an entrepreneur's standpoint, it's actually freedom. Believe it or not, if you do your job right, you will be in charge of your business, even once it is publicly listed. Yes, you'll have a board, yes, you'll have investors, but you will be much more in charge than in many other scenarios. So that's why I call this freedom. But I call it freedom with fences because essentially you can be free, but with quite a bit of constraints. Constraints of performance. Number one, there is no successful IPO without a successfully performing business. Constraints of regulatory, constraints of information that you have to disclose to the market that perhaps you wouldn't want to disclose because it's of a nature that is too strategic to be disclosed, etc. So there's a whole mindset that you need to change, but an IPO definitely delivers a level of freedom, if you want, that perhaps some of the other scenarios don't. You need to think about an IPO actually as the only exit that is not an exit. It's just a change of state where you are still in charge. And frankly, this can last forever. It can last until you retire and you decide that you want to go to spend the rest of your days on a beach in Hawaii. But essentially, an IPO, once you're listed, for all I know, UiPath might be still an independent, publicly listed company in 50 years' time, right? And it might certainly not look the same as it does today, but this is the time horizon is therefore quite indefinite for an IPO. It's a life with opening and closing windows. You can't raise money every day. You can't sell shares every day. So there are liquidity strings attached to being a publicly listed company, which might suit some people, might not suit others. And perhaps the biggest piece of all here is that I think that an IPO is great if you have at least a 300, 400 million valuation on a European stock exchange. I think that a valuation of $1 billion is great, is necessary if you want to be a public company on a US stock exchange. But anything smaller than that, I just don't find it being very productive. Now, I've actually known of companies that have tried to raise money with venture capital, that have tried to sell themselves, that didn't succeed, and then ultimately listed themselves to have market caps of 20, 30, 40 million dollars and never really moved away from that. In some cases they did. They started to execute better and they got the markets to understand who they are. But a small market capitalization on a stock exchange means no research on the stock, means no liquidity on the stocks, means basically that you're invisible, but that you are invisible with a whole set of constraints that are very heavy for your business. And selling or buying a small publicly listed company is something that doesn't happen. So that's why small cap hell is really hell. And I would definitely discourage people for thinking about an IPO before they have the right size for that. And the right size is actually quite large. That's the truth. Let's talk about private equity. Private equity is not for everyone, again, right? We talk a lot about private equity, but in reality, the late stage private equity is only for businesses that have EBITDA and not for anyone else. And that's the LBO market, and that's the market which involves lenders, which involves all sorts of people. The real private equity market, the growth market we're talking about, only looks at growth and wants to see growth, and they want to see you achieve the rule of 40. If you don't meet this criteria, don't bother. Private equity today is definitely looking at this market. It's absolutely paying very high prices. It's getting pressure from all these deals that are becoming SPACs that otherwise would have been private equity deals. So private equity is available to growth businesses today. It's moving into Eastern Europe. It's moving into earlier and earlier stage businesses. That's the case today. It might not be the case tomorrow. So private equity like IPO opens and closes a bit, right? So you need to think about that. For private equity is also a race. It's not an exit. You as an entrepreneur are in charge. You agree with a fund that you'll take your company from A to B. It's a 5-year, 6-year, 4-year race. And the key question is whether you are the horse or whether you're the jockey, right? And if the jockey is the private equity fund and you are the horse, you need to think about whether you have the energy, the will, and whether the project actually is something that you can deliver. And together with that, the real issue is, if you sell your company to a private equity fund at a very high price today, it means that the price that you are reinvesting into your company, because you'll never get a private equity done without reinvesting as an entrepreneur, that price is very high too. So you need to make absolutely sure that you are believing in your own plan for delivering an even higher valuation 3 or 4 or 5 years down the road, even though you sell your company at a high multiple today. Right? M&A, of course, is a different kettle of fish. It's something that happens every day, but it's all about being bought, not sold. It's not about writing a brochure, sending it to 150 people and say, please buy my company. It's actually about thinking through who will buy your business and making sure that you charm these people with your technology, with your ability to execute, with what you're doing, and get them to make the first approach. It's actually about being approached and not about selling yourself, right? And it's very important to understand that, because M&A is still being done too much like houses are being sold. And this is not what M&A is about. You need to know whether what you're being bought for. Are you being bought for your technology? Are you being bought for your people? Are you being bought because you have a business with numbers that bring something to the buyer? And the buyer, and this is what you see here on the right-hand side, will do acquisitions because it needs to continue to grow. It will either try and solve a point solution, or it will actually try and solve its future. So it's going to be either a tactical or a strategic acquisition. Strategic and financial buyers are not the same. We talked about private equity, and you could think of them as financial buyers. And then you have strategics. Strategics understand your business. They know exactly why they're buying you, but they're going to take a long time to take the decision and weighing the pros and cons, because strategics don't do deals every day. Financial buyers are deal makers. They're deal junkies. So they will look at your business. They might not understand much about it, but they'll have a method to learn about it and learn about it very fast. So don't look at buyers as all being the same buyers. M&A at the end of the day is just the highest probability outcome for any business at any given point in time. Anything else is actually about hard work, preparation, and really driving something that might or might not happen. M&A happens more often than not. Why? Because it's also, from a size perspective, the only or the most likely outcome for smaller startups that never make it big. And want it or not, this is really what most of the market is experiencing. A very few words about private equity, because I know time is running short. cultivate your exit. Don't be pushed into it. Think about your exit ahead of time. Think about where you want to IPO and why. Educate yourself with people who've done it before. Talk to your peers. If you think about M&A, think about who should be buying your business and why. Make sure that you build strategic relationships with your potential buyer in the future so that he knows about your business and is able to make that first step that we talked about. Exits are a 6 to 9 to 12 months exercise, whether it's private equity, whether it's an IPO, whether it's M&A. They also don't work necessarily the first time. You can try your IPO and the window is wrong. And so you basically decide to put it on hold. You can go through a first wave of M&A interactions and don't get the right thing to work because your business doesn't look quite right yet, etc. So be ready for that and be ready for the long haul. And because of that, you need to really focus on your business performance, not on the exit when you're in it, because the only thing that you have to show for is your business. If the exit fails, you still have your business and you want to make sure that it doesn't go sideways. I've seen so many companies that have not managed to exit because of all sorts of reasons, and who actually broke their company, and it took them a year, 2 years to recover from a failed exit. So think about business performance and also think about preserving your business from the exit as much as possible. The people, of course, because they are the ones that have doubts, that have questions when they know that they're in a process, right? Finally, get the right advice from the people you trust and align your objectives with them if you decide that they should be working for you. It's very important that you talk to more people than you would. It's more important that you talk to people you don't know. It's important that you don't get impressed by the first huge team that comes to your office and with bells and whistles and says, hey, we're the greatest and this and that. It's enough to have one guy who's done it before, who's your friend and who will explain to you what to look for or not. I mean, recently I had a friend of mine who came to me and said, look, there are these people, they want to buy my company, etc. I said, fine, just wait, let them make you an offer. He has a fantastic growth business, and the offer these people made was actually short of criminal. They gave him a very poor offer because they felt that he was on his own, and that they could try it on. And luckily he had me, because if he hadn't spoken to me or perhaps to other friends, he might have done a mistake. So it's very important that you don't do these things on your own. And if you have investors, typically you will be working with them. But if you don't, then make sure that you get yourself the people around you that you can work with in an exit. That's essentially what I wanted to tell you today. The one thing I wanted to add to all of this, which goes without saying, is that every exit is done with a very good equity story, which is what you're building, is done with relationships and people you trust, and those are advisors or they can be buyers, and it's done with absolutely spotless execution. It needs to just click. It needs to be clean, and it needs to be done in such a way that you avoid as many of the mistakes that and the pitfalls that are existing on your way to an exit. And that's basically what I wanted to tell you today. And I don't know if we have time for questions or not. And if we don't, that's absolutely fine. But Daniel, maybe you have a few questions you want to ask.
But unfortunately, I have to jump to the lobby in like about a minute or something. But I very much enjoyed your talk and the way you also kind of gave us a good overview of all of the understandings. Now, probably there's a couple of people going to say, how can I get the slides? Are the slides going to be made available?
Yeah, I suppose so. Shouldn't be a problem.
That's great. So they can reach out to you or to the organizer and say, hey, we'd love to have his slides.
Yeah, that's fine. Absolutely.
Perfect. That would be fantastic. In that sense, it's been a pleasure listening to you. Thank you so much for sharing all these insights. Usually they're learned way too late. That's just my personal opinion. People are, wait, well, that's how it works? We should have known that before. So if you listened out there and you heard it now, believe me, this is going to save you a lot of blood, sweat, and tears. It's still necessary, but a little less now in that sense. It's been a pleasure. Thank you very much, Peter.
Thank you.
Thank you so much, and thank you so much. And you'll be seeing me shortly in the lobby. Don't go far, because in a little less than 20 minutes, we'll have the final pitches starting, which is always one of my favorite things. So don't go far. See you soon. Thank you, and bye-bye.